Hello, everybody. Steve Ostler here is giving everybody a update on July 28th in terms of where the market is and where the real estate market is going. It's been a hot topic as of late. We all know, the market's been in transition the last year and a half, the higher interest rates. And so I'm going to go ahead and share my screen. And should be able to see my screen here.
Yes, I do.
And yeah, so today the average list price of a home is $625,000. Average days on market is 40 for the state of Utah, and the average sold price is pretty close to the average list price. It means the market's pretty close to being in equilibrium, so about $7,000 in price adjustment in order to get that home sold if the home is priced right. There's been about 2,955 sales in the last 30 days. And so what does this mean? How can we determine how much inventory we have? I like to see how many homes are listed. We have 8,475 homes listed. So let's take the 8,475 and let's divide it by how many went under contract in the last 30 days. And that's approximately 2,313. Let's go ahead and recalculate that again. So we got let's go active. 8,473 divided by how many went under contract last 30 days. That'll tell us how many months of supply we have. We had 2,314 homes go under contract the last 30 days. We have 3.66 months of inventory. It means if no new homes come on the market, it would take approximately right around 14 weeks to liquidate all the inventory, about 3.6 months. A buyer's market is normally a number that is greater than 6 months of inventory. So we're not in a buyer's market, and 6 months is considered to be normal. A red hot seller's market would be right around 1 month or less of inventory, like we had about a year and a half, 2 years ago. And so right now we're in what we call a warm market. It's kind of neutral. Their home prices are not necessarily going down. What I've seen in terms of the housing correction in the last year and a half is when interest rates started to go up, is we had homes that were like priced at 700,000 dropped to 600,000, 600 dropped to 535, the $500,000 homes dropped to 450, the $400,000 homes dropped to 375, and anything under 375 didn't drop a dollar because we have a very young population. We have a big shortage of starter homes. If I were to lower this number here, we can all see that in the state of Utah, if I look for homes that are like under, say, so let's say $400,000 in the state of Utah. That means right now we have 1,530 homes under 400,000. How many went under contract? In the last 30 days? right around 653. Yeah, you can see that we have a stronger first-time home buyer market than we do for the median home price. And then anything above 600,000, I'm starting to see that the amount of inventory is like 5, 6, 7 months of inventory on the market for homes that are priced at $700,000, $800,000. And so that gives us an idea where are interest rates at the moment. Well, the Fed funds rate was increased this last few days by the Federal Reserve. What type of impact did it have? Well, the last year, as every time the Federal Reserve has raised rates, the bond market just was pretty much neutral. And if we look at the market right now, and the 10-year bond determines the 10-year bond determines the mortgage rates, usually at about 3% of that, 2.5% to that. If you have a 720 plus credit score, maybe 3% of that. If you've got a 620 credit score, the national average rate for mortgages right now is about, say, 4 plus 2.5, about 6.5 to 7% at the moment. You can see that the 10-year started to go up in 2001, really started to go up in 2002. But since October, the bond market's been trending sideways, anticipating that the Federal Reserve's getting close to the top of the interest rate cycle, where they're going to stop raising interest rates. And that was the language this last week, is the Federal Reserve said, you know what, it looks like inflation's is getting contained, and this may be the last quarter point rate increase. That didn't increase mortgage rates. Mortgage rates have been in this choppy sideways market for since last October. What's that put us at? Maybe 9 months now, where the highest rates were last October, when interest rates were 6.75 to 7.25%. And then early spring here, they got as low as 5.875. And today rates are about 6.5 to 7%. And I anticipate when we get to this top of the trading range, they might start to head down again here. And a lot of the big institutions have published articles showing that interest rates are poised to go down about 1% for mortgages this next year, and 2% in the next 24 months. And so a lot of buyers are entering the market right now and knowing that home prices will go up when rates go down, and they know they can refinance from higher rates to lower rates at that time, and but they can't lower the purchase price. So that's why that starter home market is still so strong right now. And also interest rates are also a component of inflation. You can see, looking at the monthly inflation rate, interest rates peaked out a year ago in June at 9.1. In the most recent report here for June, is they're down to 3. The Federal Reserve wants to see inflation under 2%. It should be there this next month or two, and they want to hold inflation under 2% and above 0% for a period of time to make sure inflation is contained. Federal Reserve hates deflation going below 0 as much as they hate inflation going above 2. So you're going to start seeing, if inflation starts dropping below 0, you're going to start seeing interest rate cuts of a quarter point at a time, and they'll start stepping down like they were stepping up this last year and a half. And that's my housing market report. I'd love to hear from you. Let me know your thoughts, and talk to you soon.